There are two things that ICT said he would teach but never has. Okay, the first one is the daily bias, because all of his setups require a daily bias. So then when ICT traders fail and they say, hey, ICT, what about this trade? He'll say, oh, your daily bias was wrong, but he's never taught the daily bias. The second thing he has are the institutional levels. If you remember back to one of his early videos, he says he has his institutional levels written down on a notepad and he never draws them on the screen. Okay. Now, if he really knew the institutional levels, he probably wouldn't have failed Robin's Cup. So maybe this is more marketing from ICT. But today I'm going to show you how you can have a very strong daily bias and what the hidden institutional levels really are. So this is pound dollar, and I've been meaning to make this video for a couple of days. I just haven't had a chance to do it, so I'll do it today. Of course, I'm going to show you that Goldbach predicted this move, and the alignment is, and it follows the algorithms which I've taught you again and again on this channel. Now, if you would like to learn exactly how Goldbach operates, then there's a link to Hoppy's book in the description to this video. Hoppy is the discoverer of Goldbach. I'm pretty sure now that ICT has no idea what Goldbach is. Otherwise, he would be a better trader. But Hoppy is a source, so do check out his book so you can get a comprehensive overview. Now, if you are new to Goldbach, then click on the video in the top right-hand corner. That will give you an overview of Goldbach. The indicator I like to use is this one here, AMD power free Goldbach levels like this, okay? And based on the volatility candles, I know that GBP USD on the higher time frame is running on the 2187. So the 243 is typically a 4-hour time frame for EU and GU. I know it's running on the 2187. So what do we have running? Okay, you heard me talk about this on the lower time frames as well as the higher time frames. We have had a sweep of liquidity, okay, into the extension of the dealing range. Okay, this gives you a heads up that everybody who was short has now been taken out of the market, so then the market can move for the opposite end of liquidity. Okay, so this is buy side liquidity, so it forces people to buy to get out of their trade. And what do we have conveniently here? Okay, we have the other end of the range. Now, Algo 2 is running, of course. If you're not familiar with Algo 2, check out the video in the top right. But Algo 2 says, once we have the initiation of the algorithm, we go from the high of the dealing range to the breaker block level, retrace back to the fair value gap, and then we terminate at the opposing order block. Okay, now let's have a look. Sweep of liquidity into the high. There's your fair value gap in the fair value gap GB level. Okay, weekly fair value gap in the right place. Okay, there are no other fair value gaps that are relevant because this one is in the extension. Okay, and that's why we didn't retrace back to it. There's your fair value gap. We actually retraced from the breaker. So there you go. It hit the breaker, retraced the fair value back gap. I think it was maybe a tick off. Let's have a look. Okay, very, very close. Okay, now Forex obviously has its own price per broker, so you're not going to get exact levels. But as predicted by Goldbach, we made it to the breaker level, retraced to the fair value gap. Now our trade, okay, could easily have been fair value gap. Okay, this is the fair value gap. And now you can either put your stop loss at the high, but given that we're talking about the daily time frame, this swing high is absolutely fine. And where would you take it off? You would take it off at the order block level. Okay, that's where you would take it off. You may want to take off a partial at equilibrium, because what does liquidity want to do? Okay, it wants to sell in a premium, buy in a discount. We have liquidity right at EQ. Okay, engineered liquidity at EQ. So that is the first opportunity to conduct the offset accumulation. This algorithm plays out all the time across many, many time frames. Now, if you didn't get into this trade, you can use this as your daily bias because price should now be bearish from entering the fair value gap level. So let's see how many days were bearish after we entered the level. Okay, or after, let's say once we exited the level and we had a close below. Okay, we had a close below. We had 1, 2, 3, 4, 5, 6, 7 bullish days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 bearish days. Okay, so twice as many bearish days as bullish days. So that gives you a pretty good bias, and we still have a ways to go. Now, understand that once we get to EQ, there's usually a consolidation. That's when you get your seek and destroys. So be careful about EQ, but this is the bulk of the move. These are the easy moves. You usually have your accumulation here at equilibrium, and then we'll either retrace back up after sweeping this liquidity, or we make it all the way down to the opposing order block. Now, it's important to understand that in order to trade Goldbach, you need both time and price to align. And that's where my golden bullet strategy comes in. It takes time and price into account for us to take our high probability trades. If you would like to learn more about my mentorship, there's a link in the description below.